going on, everyone? Thank you for tuning in to another episode of Insightful Principles. I'm grateful that you all are watching at this very moment. And if you can do me a huge favor, if you could please like, subscribe, and share this video, that would be greatly appreciated. So like I mentioned in the previous episode, this is going to be a continuation of the psychology of investing. And what I'm going to talk about in this video is going over loss aversion, hindsight bias, confirmation bias, which are other psychological traps. And towards the end of the video, I'm also going to give you a statistic of what most wealthy people do as well. Now, another psychological trap is the loss of aversion. This is a very interesting concept. The loss of aversion is pretty much the concept of holding your losses and selling your winners. So you're essentially holding the losers in your portfolio, but you're selling your winners. So what I mean by that is investors tend to be more fearful of their losses, that they focus on avoiding a loss compared to making a gain. Now, research shows that investors are twice as likely to feel the pain of a loss in comparison to the enjoyment of making a profit. So I thought that was very interesting because, I even notice it sometimes for myself. When I look at a day in the market and I see my portfolio has went down, for example, $20, $30, and then on a day where I may have a gain of $30, it seems as if the days where it's in the red, I can feel it, emotionally. And that's one thing. You don't want to be an emotional investor. You want to make sure that your emotions are intact. But I definitely can feel it. And I understand that when you take a loss, it feels a lot more painful than actually making a gain. So I understood that concept when I did the research on it. And, an example when it comes to the holding your losers and selling your winners is pretty much investors. They will acknowledge a loss. They will not acknowledge a loss until it's realized. So when I say realize, is essentially when you sell your position and the investment is closed, the trade is closed. Now, for investors, what they will do is to avoid any real loss, an investor will continue to hold on to an investment, and that's where the losses will increase over time because you're hoping that you're going to see some gains, and you hold the investment for too long, and it just creates a domino effect where you're starting to draw down your portfolio. So I definitely think that the negative effect of that really is essentially the negative effect of loss aversion is holding your losers too long and just knowing when to cut your losses and move forward. Because honestly, the quickest way where you're able to analyze that and see that it's not working out for you and being able to sell that investment and move on is going to be a lot better than trying to hold on to it and hope for the best. Now, granted, if you do have a great quality company and you know that the company's financial statements are strong, they are able to acquire cash flow, you definitely can hold on to it, but just keep in mind of understanding that you want to be aware of your losses and not getting caught up in a trance when it comes to that. Now, one way you can overcome this is a strategy that I want to talk about, which is you can use a stop loss. Now, with a stop loss, essentially, you're telling the market that when it gets at a specified price, when it gets at a price that you would like, it's going to put a stop on it and it's going to automatically sell the trade. So that way, you're minimizing your risk. You're finding a way to be able to preserve your capital, and you're minimizing your risk where you're not overexposed. So the stop loss is very important, and then it just allows you to be able to prevent any future losses from happening in the future. Now, picking the percentage for your stop loss is different for everyone, but I would say not losing more than 10 to 15% on each position is a great number to start with. I know when I read a couple articles online, they did mention that, monthly you want to look at your total portfolio and you don't want it to draw down more than 6%. So that's also a great number that you can look at as well. And then another thing that you can do is you can look at doing a limit order, where you can essentially, this is on a profit end. If you're noticing that you have accumulated some good amount of profits on the position, you can stop it at a specific price, and you can be able to sell it and take your profits. So those are some strategies that you can use to, especially on the side of having losses in your portfolio, is definitely the stop loss. Now, another way to avoid loss aversion is you can hedge an existing investment by making a second investment that's inversely correlated. So one thing that I'm doing right now is I expect that inflation will increase throughout this year due to the stimulus checks that have been put out in the economy. There's already been recently a second stimulus package that has been passed and has already been given, millions of stimulus checks to Americans. And also, I look at it as, there's a lot of money being pumped into the economy, which therefore there's going to be an increase in taxes and also inflation. So I'm investing more in gold and silver in my portfolio now, because I understand that gold and silver is a hedge against inflation, and those type of financial assets tend to increase during inflation periods. Whereas, for example, with growth stocks, they tend to be negatively affected when it comes to inflation periods, of high inflation periods. And right now, I also have some ETFs in my portfolio that are in tech. I have, ARKW, I have VTI, I have different companies in those ETFs that are growth stocks such as Apple, Amazon, Google. And I know that there is going to be some drawdown because inflation is coming, and growth stocks tend to not increase during those periods. They tend to be negatively affected during inflationary periods. So that's one way of being able to hedge your investments, where it's inversely, correlated. Now, the last concept that stops us as investors is the hindsight bias. Now, there's actually going to be one more bias that I'm going to talk about after the hindsight. But when it comes to the hindsight bias, it's pretty much essentially, as an investor, if you have accurately predicted an event that has happened in the past and you were correct on that analysis, that often makes you feel overconfident that all of the future predictions that you can make are going to come true as well. And that can be very risky. That can put you in a lot of deep water, because it allows you to start to create overconfidence when it comes to making decisions on your future investments. So, for example, let's say if you had an investor that suffers a loss and they may have seen it coming and they regret that they didn't react sooner. This hindsight bias may create a feeling of frustration or regret that they didn't act in advance of the event that moved within the market. And an investor has to be very mindful of this and understand that you want to choose stocks or ETFs, index funds, mutual funds based on financial performance and not predicting how current events will affect the future performance of securities. Because when you tend to do that, it allows you to get in a space where you think that everything is right. And if you don't have an edge, or if you don't have research or an analysis that can back it up, then it's not going to be the smartest decision. So you always want to be calculated. You want to stick to your fundamentals, and you want to be able to plan effectively with looking at the financial statements of these companies and making sure that the investment that you're making is based off of sound research. So that was definitely one thing I really wanted to hit on. And the last psychological trap is the confirmation bias. Now, when it comes to this, essentially, you are only wanting to see and hear only what your beliefs are on a particular stock or ETF. So you're only going to look at articles that support your philosophy or belief on the tech sector or the the healthcare sector or the financial sector, and you're not really looking at research that contradicts that gives you the disadvantages and of that particular sector. So you're essentially only wanting to see and hear what you want. You don't want to look at all of the facts. And I think that with the confirmation bias, a lot of times as investors, we only want to hear what's going to support our financial decisions and what's going to support what we feel strongly on. But at the same time, you always want to look at the other side of the coin. You always want to look at all of the research and really compare and contrast, because essentially, with having that confirmation bias of thinking that you know it all the time and wanting to see only what's right in your eyes, it can allow to poor investments. And you have to be aware of also the downsides as well as the upside as well. So that was everything that I want to talk about throughout this episode. I hope you all got valuable insight. Like I said, when it comes to the psychology of investing, it simply is how you're programming your mind with your subconscious. Is no different with any type of goal you may have in life. What you do subconsciously with your behaviors, your habits, your actions will directly correlate with your conscious mindset. So if you are saving, if you are budgeting, if you are investing for the long term, you're doing the research on the market, you're going to be a sound and wise investor. You're going to understand how to make the right decisions. Where on the opposite side of that, if you don't take the time to work on your finances, you don't look over your financial goals, you have a limited mindset when it comes to the abundance of wealth that's out here, then it's going to put you at a disadvantage. So one last statistic that I want to give you all that I read is that wealthy people tend to spend 10 to 11 hours a month on managing, learning, and planning their investments. So these individuals are very conscious with with actively managing their money, and they're also actively involved. So I think for all of my investors out there, make sure that you're taking the time to do the research, that you're looking at ways of how you can get an edge and get an advantage in the market. Make sure that you're managing your investments, that you're reducing your risk, you're preserving your capital, you're looking at the stop loss, you're having the different hedging strategies, you're sticking to the fundamentals, and lastly, you want to plan. You want to look at your financial goals, and you want to make sure that you're taking the necessary steps every single day to get to where you want to go 40, 50 years down the line. So I did want to tell you all, please like, subscribe, share this video, and I want to tell you thank you so much for tuning in to another episode of Insightful Principles, and take care.